Hi guys, welcome back to my channel. My name is Rebecca and on this channel I go for all things accounting, finance, Excel and investment related, so if you do like this kind of stuff please do consider subscribing. Now today I know that a lot of you have been asking for level 2 videos, so we're going to go ahead and jump onto the computer in a second and take a look at a few working examples, and also I'm going to give you a little bit of background behind journal entries, that sort of thing, to hopefully help you with your studies. So let's jump onto the computer. So here we're being given a purchase invoice, and in the exam you'll see a lot of the time at level 2, definitely in the Synoptic, they'll give you either a purchase invoice, a sales invoice, a purchase credit note or a sales credit note. And what you'll see on there is the general information such as the VAT registration number, invoice number, purchase order number, delivery date, what we've purchased, price per unit, that sort of thing. Now, what I would do, even before they ask this, is I would be going through the invoice or whatever piece of documentation that they give you, and I would be adding that up and make sure that that does actually tie back, because a lot of the time in the questions that they give you, they're asking you to find an error. And in practice, when you are working, you do check over invoices and check the totals and everything balances before you post that as part of good practice. So, in this example, we're being told that we've noticed an error, the VAT is correct, and we're being asked what is the correct amount of net to be included in the control account. Now, in this example, VAT is at standard rate, so that's 20%, and that's applied to whatever the net is to get to gross. So, for example, here, what we should have is that 56 plus the 12 equals 72. But you'll see that that doesn't get to 72. So if we're being told here that this VAT and the gross is correct, it means the net is wrong. So all I need to do is take the gross and minus the VAT, and that will get me back to this 60,000 net. And I can double check that that 60,000 is correct, because if I take the total quantity of what we've purchased, these timber frames, and then times that by the price per unit, I get 60,000. So the correct amount of net to be included should have been 60,000. And again, if I want to work that backwards, all I need to do is take that 60,000, times that by 0.2, and that'll get me the £12,000 VAT that's been shown here. Okay, so let's look at question 2. So here, we've been asked to help with the preparation of payroll for the month end of April 2021. The client uses the time rate method to calculate overtime bonus and basic pay. So we're being told time rate per hour is £5.50. Each worker is expected to create 35 flat boxes per hour, and for any boxes they make above that, they receive a bonus of 25% on the time rate per hour. And then for any additional hours worked, they are paid time and a half. So we've got down here the boxes created and how many salaried hours they have versus what they've actually worked over here. So we're just going to do this in bits. So boxes expected, because they're supposed to make 35 per hour, we're going to have to times 35 by the salaried hours, because that's what's expected originally. Now, if we know that the bonus is going to be 25% of the rate per hour, the first thing we can do is take £5.50, which is the rate per hour, and times that by 0.25. So that will give us 25% of that £5.50. Now, in terms of the actual boxes expected minus boxes created, what we need to do is, if I just put a bracket around that, and times, do another bracket, I'm going to take the actual amount that they've created minus what's expected. So the 1500 that have been created versus what is expected. So that will give me the difference. That is then going to be timed by that 25% of the £5.50. So I can then drag this down here. So we can see there that the bonus we have is £378.13 for the first two, £715 for J. Keeling, and £653.13 for E. Emile. Now for the basic wage, I'm going to just take the £5.50 times by the salary hour worked. I'm just going to drag that down, as you can see here. Now, the overtime element is any overtime that they've worked above the salaried hours. So overtime we can see here is being paid at time and a half. So time and a half in a formula is going to be £5.50 times by 1.5. As in 150% of the £5.50, because they're being paid the £5.50 plus half of that again. So what I'm going to do is just do a times in this formula. I'm going to open brackets, and I'm going to take the work hours minus the salaried hours. So in other words, the difference between what was expected of them, were they being paid at normal basic wage, versus any overtime which is going to be paid at this time and a half, and just putting that into a formula there. So we can see here that actually Emil got a lot of overtime at £165, whereas Foz didn't get any at all. Jay Maguire got 16.50 and Jay Keeling got 99. So the gross total that is being paid is this basic wage plus the bonus plus overtime. So if we just drag that down there, we can see that Jay Maguire got 587.13, Fox 570.63, Jay Keeling 968, and Emil 963. Okay, finally let's move on to question 3. So in this question we're being asked to basically put the total entries into a debit or credit depending on what they are. So I'm going to talk you through each one of those. So sometimes in my videos I refer to things as being profit and loss account, and I abbreviate that to P&L, and then income statement, which is IS. So this is the same thing, it's just that under IAS and IFRS are called different things. So those are the accounting standards, by the way, if you didn't know that. So you might see it referred to either in your tech studies. So bad debt is a profit and loss item, and it is a cost because it's debt that we've had to write off. So where we've already raised a sales invoice to a customer and we know they're not going to pay it off, so it's a cost to us effectively. So that is bad debt that we're not going to recover back. Sales is going to be a credit, as we know, because when we're recording credit sales, so where customers have bought items on credit, we would credit sales and we would debit the debtors control account, otherwise known as the sales ledger control account. So that again is going to be in the purchase ledger or the income statement. Purchases, so these are just general purchases cost to us, so they're shown as a debit. And again, if we were to go ahead and buy those on credit, we would be debiting the purchases in the TB and crediting the creditors control account, otherwise known as the purchase ledger control account. So the sales ledger control account, we know that that is an asset because that is a listing of all customers that have purchased items from us that haven't yet paid. So they've bought those on credit, they've not gone through the bank yet. So that is the balance sheet or SFP. Also, this income statement, sometimes referred to as a statement of profit or loss. So you might see it as SPL. So the balance sheet, again, I abbreviate that a lot, but that's sometimes known like BS. And then the statement of financial position is SFP, like that. So next we've got closing inventory. So closing inventory is a asset set on the balance sheet and statement of financial position. So that's going to be a positive here. And your double entry there is just going to be to debit the balance sheet and then credit the P&L account. So the purchase ledger control account, so that is a list of all items where we've purchased on credit. So there we've got a liability because it's amounts owed out from the company to a supplier. VAT control account, in this case we have a debit balance, so that means that we have more VAT recoverable on purchases than we do on sales, so that is an amount due back from HMRC. So that is an asset on our balance sheet or statement of financial position. Petty cash, we know again is going to be an asset, and it's the exact same amount as the above, and that again is sat on the balance sheet or statement of financial position. Cash at bank, same sort of thing, sat on a balance sheet statement of financial position. Bank overdrawn, so this case, if we've got an overdrawn bank balance or a bank that's gone into its overdraft, then that's going to be a liability because that is amount owed back to the bank. And then we've got sales returns. So sales returns are a debit balance in the P&L or income statement, and the journal entries for those are going to be to debit sales returns in the P&L and to credit the sales ledger control account, because sales returns are basically reducing the amount of debt owed by customers. So if they have a return of an item, then they don't owe that money back. So you'll see that on the right hand side of a T account in a sales ledger control account. Okay, so finally we've got question 4. So here we've got at month end a following extract from the purchase ledger control account. So the first thing to note that the purchase ledger control account, if I can spell, is a liability. So that just shows all purchases that we've made on credit that are due out to suppliers. So here we've got a balance brought forward of 6259 and we've got a bank payment in there. So currently the balance of the purchase ledger control account is 2759. So below we've got extracts from the purchase daybook and the purchase returns daybook. So we need to update this purchase ledger control account with the below. So I'm just going to add in a few lines here. So our purchases, the original journal entry is going to be to debit purchases and credit the purchase ledger control account, and would also be debiting the VAT control account in that process. But the actual amount that's going to go into this purchase ledger control account is the gross, and it's also going to be the same on the purchase returns daybook. So here I've got my purchase daybook. Let's make that a bit bigger there, and I'm going to take this total. Next, my purchase returns daybook is going to go on this side. And again, let's make that just a little bit bigger, and I'm going to take that. So the reason for that is purchase returns are going to be a credit to purchase returns and a debit to the purchase ledger control account, because that's effectively reducing the amount of debt that is owed to suppliers externally, and that would be a credit to the VAT control account, just for your knowledge. So here now what we've got, if we just tally those up there, we've got 3860 and 10531. So our balance carry forward here is going to be the difference. So that minus that, so 6671. So that now balances off. So there you have it. So I do hope that you found all of that useful. If you did, then I'd be really grateful if you could give the video a thumbs up, or even let me know in the comments section below. But otherwise I shall see you on the next video.